So this is our first event as part of the vested community. We launched this year to essentially connect all US investors. We essentially wanted to give them a platform to discuss their investment strategy and any hurdles they face in their US investing journeys. And this is the first event that we've put together in partnership with Wright. I think Viram will now introduce Wright.
Cool. Yes. Thank you. Thanks, Yashmi. And firstly, thanks a lot, Sonam, for taking the time out. I know it's year end and everybody is kind of in relaxation mode over the next few days, but thank you for doing this with us. And and thanks everybody for taking time out actually and joining us, folks on Zoom, folks on YouTube. We are more and more trying to essentially give information or give content or knowledge to people as they start their US investing journeys. And then Wright Research has kind of worked closely with us by launching their first Vest in partnership with Vested, and so we're excited about that. We talk about that during the session, but before that, just wanted to give a quick introduction on Wright, on Sonam, and then we can get into sort of the topic for today. So Wright is basically an AI powered advisory firm. They raised their pre-seed funding earlier this year and have done some amazing work since. Sonam is the founder at Wright. She is an IIT Kharagpur graduate and is a globally recognized researcher in the field of quantitative finance. She has almost now 10 years of experience in quantitative investments and trading across HSBC, Edelweiss, Qplum, and excited to have you, Sonam. Thanks for taking time out. Today, I mean, the format that we wanted to follow is just pretty much Q&A. Pick your brains on some interesting topics that will help our investors who are starting out new, and then open it up for some audience questions as well. Or if audience questions keep coming in, I'll kind of sprinkle them in the middle as well. So cool. Starting off. So I mean, just the focus was primarily in terms of asset allocation, and today more than ever it's become more and more important as we have a bunch of different assets now available, right? Like technology simplifying access to, I mean, US stocks, private markets, cryptocurrency. So how should one think about asset allocation, Sonam? What are your thoughts around the asset allocation?
Right. Yeah. So asset allocation, I think, is the primary tool that we have to tackle market volatility, right? So whenever there is risk in the market, the best tool that we have in our hand to tackle it is asset allocation. So what asset allocation means is that you get a sense of how many different types of assets are there, right? So there is equity, which is investing in stocks, and now with Vested you can invest into US equity, European equity, emerging markets, and a lot of different equity assets. And then there is bonds. So in bonds, you have corporate bonds, government securities, short-term bonds, and these are also across geographies, Europe, Asia, US. You have commodities, various commodities, be it gold, platinum, silver, etc. There is oil, metals, etc. And then you have real estate and certain other alternative things that have come up, right? So even in equities, you start with we start with index funds, but there are now so many other diversified opportunities present, be it various sectors, be it these innovation ETFs, be it ESG, be it various diversified types of opportunities present in equities. So the job of an asset allocator is that we want to allocate to the appropriate sector at a given point of time. And asset allocation doesn't need to be, very active. So the most basic type of asset allocation that somebody can follow is that just do a 60-40 or 80-20 allocation based on your risk profile. So if you are a high risk taking individual, allocate more to equities, less to bonds. But if you are slightly conservative, increase your bond allocation. And if you're very conservative, have a very high bond allocation, right? So that is the primary rule of asset allocation, that it should suit your risk profile. It should suit your goals and what you are looking to do with your investment. So that is your strategic asset allocation, and then on top of it, if you want to be dynamic, right? Because like we all know that markets keep on shifting. There are certain times when global markets do much better than domestic market. There are certain times when Europe does better than US, and emerging markets do better than the US, and other times US takes over the others. So you can also shift your allocation to these various asset classes available, and that is dynamic asset allocation. And what we like to do is something called tactical asset allocation, where we're not just dynamic, but we're tactically shifting our allocation to newer opportunities in the market to capture short-term trends along with long-term trends, and give the users a performance that is, that takes care of the risk, right? So if suddenly the risk increases in the market, and the federal tapering happens, in those times we'll allocate more to US bonds and those ETFs. And when the markets become favorable, we allocate more to equity strategy, right? So I think asset allocation, knowing the various asset classes, knowing you know which particular sector or asset class the economy is favoring, right? Like right now, real estate is in favor, so we have a good real estate allocation in our portfolios. But if the federal rates start increasing, you'll see that money quickly shifts to US bonds. So at those times, you need to shift a little bit of your capital to those asset classes. So I think that is a broad philosophy that you have to follow, and there is no set rule for doing that. You have to work with a strategy that you think works best, backtest it, evaluate it in various scenarios, and then bring it out as a offering to your clients. Yeah.
Got it. Super helpful. So you could basically think about it as strategic, dynamic, and tactical, right? And tactical is
Yes.
more if you're surveying the markets as frequently as you do as like a professional investor. Let's say
Right.
I'm a more retail investor, just from a retail investor perspective. I started off with an asset allocation, said, okay, I'm going to do 60 equity and 40 bond.
Mm.
How frequently do you think then, if I'm not taking professional advice, like how frequently do I relook at it and then kind of figure out, okay, now after a point, stock became higher, bond became lesser, or the macroeconomic situation changed? Like, how frequently should a retail investor be looking at it again and again to keep moving it around, or just set it and leave it for a long time?
See, setting and leaving it is also not a bad strategy. Obviously, it will lag the other types of asset allocation, right? If you're dynamic, then you can add additional alpha on top of your strategic allocation. Uh, so I mean, I believe that people should be reviewing their portfolios at least on a 6-month or a yearly basis, right? Because the market do shift significantly in certain time frames. And what we also believe is that there could be phases, like if we look at the market last couple of years, we have been in a bull market, right? Where equities have done better than bond, right? There's no doubt about it. Right? So that is a 1.5 year period, and the market has not shifted. But there are certain significant times when the market allocation sort of shifts. So I call it a regime shift, right? That the market was in a trending regime, and now it is shifted to slightly volatile. So what you can also, like what asset allocators like me or managers like me try to do, is that we try to look at the regime, right? That the market is giving us the indication that now it is time to shift your allocation. So whereas you don't need to shift a lot while the market is in the same regime, right? You can keep your allocation static, but when the market shifts, you should sort of shift along with that.
Got it. Very interesting. So you look at it kind of as like I like the word regime. It's like a major shift is kind of happening, and that's when you should,
Right.
as an investor, be like, okay, I need to relook things. Otherwise, let it be. Don't bother about it too much.
Right.
As an individual investor, and so as a professional investor, somebody like you at Wright,
Yeah.
what are the kinds of things that you're doing to asset allocate? Right? What are the signals you guys are putting in to figure out, okay, this is where we should be at this point in time, or this is how the economy is changing across the world, in the US, in India. Talk to us about kind of what goes on behind the scenes.
Yeah. So see, like I said, the basic thing that I start with is a regime model, right? That what is the regime that we are in, and what will be the regime in the future, like in the month or 6 months down the line, right? Because we don't want to work with historical data. We want to forecast, right? When we are allocating, right? We want to forecast the future. So for doing that, we look at a set of macroeconomic data, and for the US market and the US economy, there is a very good data set for economic data that is available, right? And it is much more active compared to the Indian market. You have your jobless claims and a bunch of other numbers that come out very actively that give you a very clear indication of where the economy is heading, the bond yields, inflation numbers, the GDP growth and the projections and the consumer confidence, things like that. Plus, we also look at, the short-term signals that the market, the prices itself is giving us, right? So be it, if the market is too inflated, if the price is too inflated compared to, a long-term trend, then you can expect it to sort of mean revert. So we include these signals along with the macroeconomic signals, and we try to forecast how the market is going to look, few months down the line. And if our model says that, and the accuracy is fairly good, right? Because markets are, you see, in the long term very highly dependent on the economic conditions and the bond yields, right? And so if you see that the market is going to be volatile in the next period, right? So in that case, what we try to do is that we allocate more to low risk assets, be it bond, be it gold, be it short-term bonds, corporate bonds, um, during those periods, or even to low volatility equity strategies, be it low volatility strategy and defensive strategies at that point of time. And when we see that the markets are okay, have come back, it's in a trend, the forecast is really good. During those times, we allocate to more high risk equities. And again, like there might be times when you know tech is trending, right? Certain like a few months down the line, your innovation, your Tesla, and your all these things were really rising very rapidly. And like the sectoral allocation can also shift, right? Like maybe tech slows down a little and infrastructure grows, right? Real estate picks up growth, right? So you have to be aware of those things and allocate to those particular sectors and industries.
Got it. And
Yeah.
for you guys, is this algorithmically driven the way you've set it up, or it's a mix of kind of human inputs plus an algorithm that's working in partnership with that?
No, so it is a purely algorithmic thing that we do, right? And yeah, so the regime model, like I said, is an algorithm that forecasts the regime, and the allocation to the various we use ETFs and various for different asset classes happens again through an algorithm, which what it is trying to do is it is looking at the previous performance of each of these ETFs and trying to maximize the performance of the portfolio, but it is trying to also reduce the risk. So this is something that we call mean variance optimization, where we are trying to maximize the returns, but we also want to reduce the risk.
Got it.
Yeah.
Understood. And you spoke about sectors, and in terms of sectors coming into highlights, going away from
Yeah.
kind of the attention. So internationally, what are some sectors that you're looking at? I mean, you've had international investing experience
Right.
in your previous roles. So
Yeah.
what are some sectors that I mean, tech has been by far the favorite, and we've seen on our data. But like, is there things beyond that people should be looking at?
Yeah. So see, so if you look at the previous few years, tech has had a great run, and then couple of other themes which have also outperformed very significantly. One is the innovation theme, which are ETFs too, right? Where they're
Yep.
investing into fintech and genomics and e-commerce, etc. That is one theme. Second theme that we've seen really, pick up is ESG, right? Where companies that are environmentally aware, that are, socially aware, they are getting a lot of push, and electric vehicles and all that also fall into that particular basket, right? So these two themes are, apart from tech, have really picked up during the last few years. Obviously, it is tough to say if these exact themes will be working in the next year. And we have had allocation to each of these themes historically, but right now we don't have a lot of allocation to these themes. Right now we have a higher allocation to real estate and healthcare and things like that, because the market itself is shifting, right?
Got it. And
Yeah.
one of the questions that we have from Ajit is, I don't know if you track it, and let me know if you don't. So it's more on kind of how is the outlook for markets, right? So you could do an ETF, which is, let's say, investing in the China market. But this entire last year has been quite turbulent for Chinese equities and given the entire US-China equation. So do you have any thoughts? Did you get a chance to look at that at any point in time in terms of how the outlook might be for these equities going forward?
How the outlook might be for each of these equities going forward? I mean, we use a little bit of momentum type of signals to, sort of take our allocation to these different geographies, right? Um, and I mean, it's a good idea to, have a forecast model for each geography based on, their own economic conditions and the global conditions. But right now we do rely a lot on momentum type signals to do our allocation to various geographies, right? And if you look at global ETFs, you'd see that when investing for the in a global ETF, you will see that the return that you're seeing for Indian equities does not translate exactly, right? Because there is a currency differential, right?
Yeah.
So what happens is that due to the currency effects, your Nifty returns will be slightly dampened, right? When you look at the MSCI India ETF, right? Similarly for China and other geographies. So for a US investor, a Indian ETF or a Chinese ETF does not have, a very high outperformance compared to the US market. There is a slight outperformance, but it is not very, very significant because of the currency effects. So so that's why, we don't have too much allocation even to emerging markets. We have high allocation to US sectors and US ETFs in this particular portfolio.
Got it.
Yeah.
Got it. Yeah. I think this year it's been almost similar. I mean, I was seeing the other day Nifty 500 was like about 21%, and S&P 500 was like 25%.
Right.
In terms of returns for this year. It's been quite the year. I mean, what are your thoughts going forward, right? Like, I think overall people have just become more and more skeptical. Like, what were the drivers until now? I mean, or sort of the regime, right, until now is likely to change going forward as inflation starts kicking in, as Fed tapering starts. What are your thoughts on how one should be looking at the markets next year?
Yeah, so see that is a concern, right? Inflation and Fed tapering, they're obviously a concern because the example that we have is 2013, right, where the Fed tapering started, and the emerging markets, everything became very volatile, and that was a scary period. I think all the currencies appreciated and things like that. But right now, I think global and the Indian economy, everybody is in a much better state. So while we will not see, the returns that we saw in 2021 and 2020, right, which was crazy, we might see a slightly dampened return, I think, from the equity markets, but still, the earnings are very good in the US, in various other geographies. So that will definitely have an effect on the stock market performance. And I think the market will digest the tapering much better compared to 2013, because a lot of uh, a lot of policy making has been done to make sure that such volatility because of a single event doesn't happen again, right? Obviously inflation is concerning in the US because they've printed a lot of cash, and we'll have to see, how that pans out.
Got it. Got it. And in fact, one of the questions that's coming in on YouTube is kind of taking us back a little bit to allocation, is just a basic question in terms of how does one think of allocation between the US portfolio and the India portfolio?
How does one between the US and the India portfolio, right? So how much you should invest into US and how much into India?
Correct. Correct.
So see, I mean, India is not a bad market to invest in. It has a very good growth projection. It is a growth country, right? So it should sort of outperform in the long term. But like I tell, and like at Wright Research, we have been doing, Indian advisory for a couple of years. But we do advise our clients to allocate some amount of their capital to US markets, because there will be certain time periods when US will definitely outperform India. US equities or US bonds will be a better alternative to Indian equities. That time is going to come. So it will always be a good idea to diversify your capital between India and US, and looking at your capital and how much you can invest in the US, you should make that decision on how you want to split between the two geographies.
Yeah. 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 We typically, people have been like 80-20, but we've seen people go all the way to even the other way, 80-20. Like usually it's like 80% in the India markets and 20 internationally. But I mean, through Vested, we've seen people do 80 in the US, 20 in India as well. So it really depends, I think, on what the individual's kind of capabilities and risk profile are, right? That's what Sonam is also saying.
Yeah, and obviously US markets are much more developed markets, right? So I mean, it's not a bad investment in any sense. Right?
Yeah. Yeah. And talking about that, like invest in the US market. So what we have done, Right Invested together, has created a portfolio. I mean, Right has created a portfolio. We are a platform for kind of allocation in the US markets. And the reason for us to do this was we realized that a lot of people, while they want to invest internationally, don't really know how to create a portfolio, right? It's a very new market. When you might know 2-3 ETFs, but beyond that, there's a whole world of different ETFs available there. So Sonam, do you want to talk us through kind of what was the thinking behind the portfolio that Right has put together? You mentioned tactical allocation. So give us a little bit of download on what tactical allocation is and how people should think about the portfolio.
Yeah, definitely. So I actually have, a background in working on tactical allocation on the US markets in my previous role at Qplum. So Qplum was a company that, that worked for 4 years creating tactical asset allocation portfolios for the US markets using these ETFs. And they used, a lot of machine learning. They were much more active. They used to trade very frequently on a daily basis. But I think the learning from there was very, trading daily will lead to too much cost. It is too, I don't think it's a sustainable strategy. And I thought, we can create a much better strategy if we trade on a little less frequently on a monthly basis. And we have been seeing that the interest among the Indian users is increasing more and more towards global equities. We have received a lot of requests from people that, what do you do something for global market? Can you advise me how to invest into global market? So that's why I thought that, this opportunity of collaborating with Vested was perfect to, take my experience and create these good products that people can use by allocating to global markets, right? And like you said, people, there are a few ETFs that people know, right? Be it QQQ or be it, some of these popular ones that, they think that are there, but there is a whole set of ETFs globally, right? So if you're talking from an Indian perspective, there are hardly 5 liquid ETFs in India, but globally there are, thousands of ETFs that have a lot of liquidity, right? And these are very diverse ETFs. It's not that all of them are following the S&P 500. You have ETFs for each sector in the US economy, like many subsectors, the industries that are very attractive, be it semiconductors, be it digitization, be it ESG and innovation, like I said, You have ETFs for bonds and real estate and gold and very specialized categories of that. And I think, it's a whole big problem to solve in itself, right? And it's a very interesting problem to solve, actually, which particular geography and sector you should be allocating to at any given point of time. And US tactical asset allocation, I think, is a very popular strategy that, a lot of advisors sitting out there in the US do, right? It's a huge market allocating to ETFs where people do this. And I thought it would be perfect to give our users a flavor of this strategy where they can allocate to this particular strategy and, really diversify their investment that they're doing.
Yeah. And so one of the questions that has come up on YouTube is, would you guys be coming up with different vests for different risk profiles and different assets going forward? Because right now there's, I think, one that you've put out as kind of first foraying into the US market. So
yeah, so see, I mean, so like I said, when I used to work for the US market, we would have, four or five different risk profiles, right, for the US investing basket, because US investors were investing into it, right? So a moderate risk person could just invest into the moderate risk basket, and the high risk person could just invest into the high risk basket. But here, I think Indian investor will not be putting all of his money into this particular vest, right? He would be allocating a smaller percentage of it. I think that is the idea, right? So what we have done is we have created like a moderate risk basket that anybody can allocate to, because we know that they are not going to allocate the full amount of capital, right? So it could be a subsection of their portfolio, which where we are not very conservative. We do have allocation to high risk equity strategies, but again, it is very well diversified and it does include bonds and gold as subjects.
got it. So yeah, basically for somebody getting started with the US market, this would be like a sort of a good way to get going, and then as you develop your portfolio,
right,
we can do more and more. Correct. And one of the questions from Russian is that if we can provide a rough cost breakdown on the vest. I think it's a fixed subscription, right? You want to talk about it, Sonam, for a second?
Yeah, so it is a fixed subscription, and we have started with a 6-month model, right? Let me just check. I think the cost for 6 months is around 2,500, if I'm not wrong.
Yes.
Yes. So that's it. Like, that's a fixed cost model that we have for our portfolios, and you can subscribe to it for 6 months, and we tend to we rebalance on a monthly basis. On a monthly basis, we'll send you an update on the portfolio, and we try not to churn too much so that we save on the taxes, right? And the idea is to pick up the correct set of ETFs and for the current market condition, right? So right now, if you look at our portfolio, you'll see that we have allocation to real estate and healthcare along with some large cap sectors, because these are the things that are doing well, and the performance is quite good over the last 1 month, right? The real estate, healthcare, and the large caps have done pretty well over the last 1 month. That is the allocation that we have right now. But as the market shift, as we get more clues on what's going to happen, we will adjust the allocation within these ETFs going forward.
Yep. So glad that it's not completely tech focused, because I really want people to diversify beyond tech, because there's so many other opportunities too.
Yeah. I mean, see, we will also be maybe, if we go into a scenario, where tech is doing the best, right? So we will also probably become more crowded towards tech, but we are not, we will shift as the market conditions shift.
Correct. Makes sense. Another question is, what are risks do you think, I mean, this is not related to the West, but generally on the US market, any risks that you see in terms of risks that can lead to corrections in the market?
So risk that can lead to correction in the market, there is the risk of the Fed taper, right? Like right now, the clear risks that are there are the Fed taper, the inflation, right? And maybe some risk coming from China, where the real estate sector is going through some volatility, even though it is very well contained. And then there is Omicron, right? So these are some very clear risks that you have. But we all know that uh, US market will be much more robust to the virus threats because they are much more advanced in terms of the vaccines and the various healthcare that there is, and even if the Fed taper happens, there will be shift from equities to bond. But again, US equities will outperform the emerging markets during that time. So right, I think so. So this is the correct time where you should have some US allocation or global allocation, because when the tapering happens, emerging markets tend to struggle more than the global markets, right? So I think that is a plus for US investing during these times. And obviously we will have allocation to US bonds when it is the correct time to allocate to them. And globally there are some bunch of very, very interesting themes that work irrespective of the market, which will be very interesting to watch.
Got it. Cool. I think a couple of the other questions are on the withdrawal process at Vested, which I can take, Prince. So that's something that we are definitely working on. And deposits was the first thing which we wanted to simplify via Vested Direct, and now withdrawal is also something that we will simplify very soon. And I think I have covered pretty much questions across. There's a question: do Wright Research have any ETF / small cap which can be seen or invested via Vested? Okay, I think that we've answered already. Okay, I think we've covered all of the questions, and unless there is anything else, I think we are also at time. So cool, that's my cue to then wrap it up. There is one more last question I think then we can take. Is Sanjay asks, Sonam, if you have any thoughts, is what is the delta you kind of foresee in the India versus the US market? Any thoughts there?
Right, so I think, see, if you look at the GDP growth rate and the earning growth rate, you might see that is higher for India, right? Because India is an emerging market compared to global market, so that growth might be rapid for India. But yeah, markets right now are much more driven by liquidity, right? And liquidity, whenever it goes away, at that time US will become preferable to India for some time until things stabilize. So yeah, it's a mix of a few things, right?
Got it. Cool. Okay. Thanks a lot, Sonam, for doing this and taking all of the questions in such a sporty manner. And it was a pleasure. Thank you everybody for attending as well. Looking forward to seeing you guys soon. If you have any other questions, you can always post them on the community, which is at community.vested.co.in. We'll be there to answer them. And take care and Happy New Year in advance to everybody. Thank you, Sonam, again.
Thanks for watching. If you like our content, subscribe to our channel and hit the bell icon to get regular updates.